you a non-resident who's thinking that he or she wants to sell their property in India and you are not sure what formalities you need to comply with or what things you need to be aware of before even entering into a sale agreement, this video will help you with those details. So do watch right till the end, because we'll talk about very, very critical steps which you need to follow. Otherwise, you can land into a big tax soup. So before we go ahead, a quick introduction about ourselves. My name is CA Puneet Agarwal. I'm the founder of Banyan FA LLP, where we are one-stop shop for all finance needs of people. Please follow us on Instagram and YouTube, where we release weekly videos related to personal finance. Okay, so let's take a situation. You bought a property many years back. You want to sell it now and take the money outside the country. So obviously the things which will come in your mind is, what steps do I need to take to ensure that that money goes out of the country? But before the time from selling to taking the money out of the country, you will have to follow multiple steps. I'm not going to tell you about which broker to find, because that I would leave to your discretion. But I'll tell you the financial part of this transaction which you should be aware of. The first thing and the most important one, do check out whether you have a PAN or permanent account number. Very critical, very crucial. If you do not have a PAN, apply for it in advance. If you do not, then the buyer will deduct a lot of tax and you will not be able to even claim it back. So apply for it well in advance. It roughly takes less than a month for you to get your permanent account number being sent across to you. If you already have one, check it out whether it is operative in nature, because the PAN and Adhaar needed to be linked, and back in 2023, wherever the PAN and Adhaar have not been linked, the PAN have become inoperative. Inoperative PAN, for all practical purposes, is same as that you do not have a PAN. We have a very detailed video which you can use as a step-by-step process to activate your PAN back again. The link is in the bio below. Okay, now you have a PAN card and it is an operative status. What do you need to do next? You need to let your broker and the buyer know that you are a non-resident. Many times this part is ignored, and that results in a problematic tax situation. Why? Because when a buyer is buying a property from a resident Indian person, a person who's living in India, let's say if you were living in India, then any property which is above 50 lakhs sale value, उसपे उनको केवल 1% tax deduct करना पड़ता है, and then it is deposited with the government. You can file your return and claim it back if there's no liability on your part. But for a non-resident seller, I'll repeat, for a non-resident seller, which most likely would be you in this case, or if you are a buyer who's going to enter into a transaction with a non-resident seller, please understand that you have to deduct tax at 20% plus cess rates, which would be around 22%. If the property was purchased over 2 years, which is basically long-term capital gain. If it was purchased in less than 2 years period, then it is 30% plus cess, which you had to deduct. For doing that, the buyer needs to apply for a TDS account number and then deduct 20% of the sale proceed. So example, if you bought a property at, let's say, 10 lakh and you're selling it for 1 crore rupees, the seller would get the money after the buyer has deducted 20%, which is 20 odd lakh rupees, and will give roughly 80 lakhs to the seller. This is why you need to tell the buyer well in advance that I am a non-resident. Please ensure that you comply with all the tax formalities. Why? From a buyer perspective, it's very critical. If the buyer fails to deduct this tax, it is his tax liability to ensure that he pays that to the government. He cannot run away from it. And in that situation, the buyer may go to the court and tell the courts that the non-resident did not tell me that he or she was a non-resident, and as a result, he was perhaps not being in a position to even know that he had to deduct. Unnecessary, it will create unwarranted issues. So better tell your buyer well in advance that, hey, I am a non-resident, please ensure you deduct appropriate tax. Let's say that part is also sorted. The third step, when you are getting at this time of registering that sale, you need to ensure that the buyer has deposited that amount of tax with the income tax authorities and presents to you a challan copy, or it's basically a receipt showing that this much amount of tax has been deposited with the income tax department. Those details must be expressly mentioned in your sale deed, saying that the buyer has deposited this much amount of tax via this challan number. And it must also say that if this challan is not deposited or there is some issues with it, then the entire sale would be considered as invalid. This is very crucial. Otherwise, your amount of tax, which is 20%, your property might still get sold off and you may not get hold of that tax amount which is deducted. Okay. Now you as a non-resident might wonder and think that while the buyer has deducted 20% tax, my overall tax liability may not be 20% on that sale. Example, if you sold the property for, let's say, 1 crore and you bought it at 80 lakhs, your gain were only 20 lakhs over there. So in that situation, you were supposed to only pay tax. I'm ignoring those tax complicated calculations around indexation, but simply if the gain was 20 lakhs and you were supposed to pay 20% tax on those 20 lakhs, which was 4 lakh rupees only. But owing to these provisions, the buyer would deduct 20% tax on the entire 1 crore amount, which is 20 lakhs. So you would think, what has happened? I mean, my gain tax amount payable was only 4 lakhs. Why the buyer has deducted 20 lakhs on it? So in that situation, you have two alternatives. The first one, after the financial year ends, you could file your tax returns stating that this is the amount of sale, this was the purchase price, and the capital gain which is applicable to you is at this rate, which is 4 lakhs. The buyer deducted 20 lakhs and take the entire amount of 20 minus 4 lakhs, 16 lakh rupees as refund. It's very seamless. We have done it for many of our clients. It's all comfortable. The other alternative is that before you enter into a transaction, you get a certificate of lower tax deduction from the income tax authorities. This may not always be very straightforward, may require a bit and bobs of paperwork to get it resolved. So in many cases, I've seen people being more comfortable. Okay, you deduct that tax, I'll file the return and claim that money back. But you have to ensure that you do not forget to file your tax return, because a big chunk of your money is perhaps being deposited as tax and you do not need to kind of pay that much amount. You can get that money back. The last point of this channel is that your money has come into your bank account. Now you want to repatriate it to your home country. How do you do that? This is a whole completely different topic. We have a detailed video on repatriation of funds to your home country. The link is in the bio below. Please go through it. It will help you to understand the process. I hope this video was informative. Do not forget to give a thumbs up to this video, like it as well, and please do subscribe to our channel. We release regular videos associated with personal finance, taxation, non-residence, investments, and other risk management strategies. I'm sure you would benefit out of it. Thank you so much.